We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is returning guest Francis Hunt, CMT in technical analysis and founder of themarketsniper.com. Thanks for joining me today again, Francis.
Delighted to be back. Thank you for having me.
Absolute pleasure to speak with you again, Francis. So the last time you were on, we went through a lot of charts, explained a lot about technical analysis. You're back with us today to really go over some of the same things, update us on some of the calls. So why don't we start, or where do you think is a good place to start for today's conversation?
Well, there's a couple of interesting things happening in the energy market, which might make for a great parallel. Mm-hmm. So everybody's here for precious metals, but I think short term, they might not have the best news. Long term, I have a parallel that's worth sharing. And as I've said before to your good self, and I will continue to repeat, the people that are engaged here are in the trade that is wrong, and suddenly going to be very damn right. And the key thing is patience. We were also talking about stoicism in crazy times, and that patience is very much defined. There's a degree of suffrage. You earn your money through your patience, watching other things go. You get the distraction of crypto that's created. Of course, it's electronic. It's in a blockchain. Things going up so much, and everybody laughing at you. Oh, wait for your 30 years to get your 2x. I've done X, Y, Z, and I see place very strongly for precious metals. I'm a massive silver bull, but I also recognize that it's a lengthy period since the last surge, and people's maybe head hanging a little bit. I'm here to give them some confidence, but also to remind them you earn your money in your patience, and also to show that parallel in the energies market, which was kind of really, really interesting. On that point, we haven't started to show any charts, and I'll put that on in a second, but I don't know if you've been following the UK news where they were having to fire up and maintain their coal furnaces, that great evil, to maintain the grid up in the UK. So there's real energy shortages. You've had Sprott that have been engaged in uranium, and you've had the uranium moving recently. And we've been occasionally mentioning good old natty gas, which isn't the sexiest concept in the old days. I still might be the case in the US. I don't know. I used to burn it off as a waste product. Pumping and flying. So big numbers can and will come, and I believe that day will arrive for precious metals. What I'm not going to say is it's just around the corner if technically it doesn't look like that. Thank you. You introduced me as CMT, Chartered Market Technician. The idea is I want to know when things are going to go down as well, not if. And some of your guys will be wondering, okay, I've kind of bought into the when it's going to happen, but when is the if? So let's talk a little bit technically. Maybe I'll even show some of those charts if you'll allow. And I'll go for the share screen if that's okay, and we can bring you in on the technical side of things. This is the gold chart, and we'll start with gold actually. Now I'm on a 4 hour, so I'll just go back out so that everybody can orientate themselves. My charts are typically messy because I do quite a bit of work on them. This is the monthly. Normally on big time frames, by the way, you should always be in a log scale. So I'll just convert that for you. I'm going to take some of that, the hallmarks. We only went slightly higher. It's the key point, actually. Before I clear this out, I'm just going to take the eye off there so that we lose some of the mess. On the big time frame and do this overlay draw, we only went slightly higher over there. Now, this is an important part of particularly HVF method. So we've also found our way to a unique way. There's a bit of dogma in technical analysis that I'm not a fan of. So we found our own trader's way through to technical analysis. We're involved in trading the longs over here in this bull market that I actually assessed to have been truncated. It wasn't fully allowed to finish. In other words, we didn't get the fullness of the bull that you got way back in the 80s in terms of presentation. And this was a marginal high. This is why I sometimes think the precious metals genie has only been partly let out, even in its most bullish moments. and why when the lid is properly left off, those that have been mocking you from the crypto world will actually see some big moves occurring in the real world as well for precious metals and what can happen. And we'll revert back to the energy discussion to highlight some of that. But a marginally higher high is not normally particularly bullish. It points to a bit of fatigue. I call it the support and resistance trader's trap. You run the previous high. Everyone gets super bullish as the headlines come in. And this is kind of like some people refer to the notion of a bear trap when you're in a bull market. It's kind of like a bear market guy's trap, because a lot of newbies chase in as you make that new high. You push up a little bit. You fell short of 2-1, bearing in mind you were in the last high was already mid 1900s. And then you get that first pullback that breaks everybody's spirit. And it shakes out anybody who's over leveraged, and you get that dip. But some technical analysts will say you're getting a little bit of what's known as a cup and saucer in that. But the marginally higher high is short, medium term, a little bit bearish. But you can, in the end, after a pullback, end up with a structure like that that can be positive. Not a massive fan of talking about cups and saucers, because targeting wise, it's a bit difficult, but there could be longer term, a bit of a structure like a rising wedge that is going on. So I'll just focus on, I don't want to just talk with that top part. Let's get this a little bit more in view. We're on the monthly time frame, just to remind people, always when you're doing technical analysis, start macro. So it's very much a macro to micro journey that you go on. So I'll grab the line here, we'll fatten it up, draw fat cokey so it's nice and clear. You've got a bit of a capping ascent there. Now, I'm wondering if we don't come off a little bit first, squeeze around, and then come up. Now, many people go, rising wedges aren't particularly bullish. No, they can be. You can get what's called a type 3 rising wedge, where you squeeze and you melt up through the top. So just because we create a structure like that doesn't mean you couldn't make another marginally high of a small pullback, or still be in a largely constricting environment, and then you go melt up. This points to it not being something that's just about to happen on the macro chart. If we were to go this, so I've shown you one scenario casting of that. I almost, because of the proliferation of dollars, prefer to do gold relative analysis against other things. So when we called the oil collapse, we found that oil was disproportionately expensive to gold in barrels per gold ounces. So I'm a massive fan of technical analysis cross assets as well, instead of just looking at it against the flawed devaluing dollar. On other assets, you might not have had that leak out the top, and you're more prone to have a possible continuation pattern, because dollars were being printed, hence the leak out the top. But in other asset categories where there's no printing, commodities, you could indeed have a more traditional squeeze, which is exceedingly bullish. So you've got to bear that in mind. The benchmark that you're measuring in is a flawed benchmark, and it's been proliferated. And we were commenting just before we started about, the 25% of all dollars ever created being in a single year. And then you can't be surprised that across the board, on average, 25% increase in homes, because people are converting fiat into harder assets. If I just take you into the shorter time, and why we're doing gold so much, we see it as the God market for precious metals. We'll also look at the ratios. So I'll drop you in, and I'll slowly bring my drawings into this. And one of the key observations that I'll make as we drop the time frame into this, that's weekly. I'll take you through to, say, a half week, that's 3 day. I'll put the eye back on, and you'll start to see a little bit of that. When we were having our blow off high, we were in a rising wedge. That was it over here. So I'll just re-highlight that short bit of history so that you understand where we've been and why we got that blow-off move. And that was over here. This was your previous legacy high in and around, I think it's the 1900s and 27. So you just ran it, then you had your blow-off. It got stomped on at the 2088. And since then, you've been in this broadening structure on the downside. Now, we call that a slide. Now, the value of a slide, it's some people think of megaphones as slightly different in terms of how we define broadening structures, but you're thrashing out the volatility and getting ever broader, and eventually you start to base and you square up. That means you trade through this top line, and that's when you set up then to go again. Now, a very interesting level is here at the 1675s. I'm highlighting this low was 1673. And that was 1678 on gold. And also, this coincided with the big event of the year of 2020, which everyone now remembers, and I won't even say the name, but involves likely travel passports and everything else coming into play, and is the big biohazard, and that's it there. You had a little bit of a dip, then the big event occurred, which was all March 2020, and you came back. In both instances, you were resisted there. In fact, multiple instances, I said both. There were many instances where you were held back at a level a number of times. I'll go with the arrow there and just highlight that. Held back, held back, held back, held back, and then broken with momentum, yes, and then support now, support, support, support. That is very much enforcement of the traditional technical analysis theory of a very strong level that was shown to be resistance and then pivots into support. And that is then verified and ratified again with the just run supported off with quite a strong rally off there, which was in a channel that eventually broke to the downside. And then again, you see the snapback. It's almost an electric fence. The spiller, an absolute thriller all the way from Manila, came all the way back down here and then off she goes and she's bumped off back again. So you've had the validation of the 1675/80. Remember, you don't want to think too accurate on something that is a broad science. It's a 1675, 1670 to 80 level. And we've got an impulse again that's brought us back up. So one thing we do know is, I would argue, for this broadening structure, we through with visiting downside. So the next move is the release of this, what we call a capping descending grind line in there. We also split it, as you'll note, so you get half moves in a number of places there. You had a short period above it there, and then again there where you slipped back before you broke. Now we're supporting on the other side of that splitter level that is breaking that. So we are getting to the top floor and we're moving right through that, and the eventual news will be breakdown. But that doesn't mean it's happening right now. We can still venture in this top floor down for a while before we eventually get the break. And when I drop down to the shorter time frames, it's going to feel slightly more negative of short-term outlook. So let's do that.
Francis, before we move on there, is there any way of really trying to figure out how many more tests of that 1675, 1680 level we could see before it starts to break out of that?
I would already be biasing towards it's probably had its last. Now, I can't tell you for absolute, as you can well understand, but typically such a rejection with the wick, this was a real snapback. It was a real impulsive spill, and there was a real strong reaction to the market. Can I highlight, I've dropped the time frame, which I was going to do anyway, but I think it goes a long way to answering your question. So let me just do this and follow through. You'll see the answer coming. The last time we here, it actually took a proper run, and it had a moderated reaction to the first visit. So much so that it actually came again to be bounced on your 1670. That's not an electric fence. It's like we're going to have a proper lean here and see if we can push this wall over. Once we try, and we came back after a small bounce and we tried again. You may see there's a cluster of other lines in here, and that's a neckline for this blue line here is a neckline for what ended up a W bottom, which is a natural reversal pattern. And you played footsie with this key level. You did a little bit of a handle on it, and then you broke it with momentum, and you were done. And even in this down leg, you showed temporary support on that W bottom neckline. So what's happening now is we're laying down fairly firm layers that aren't indomitable because they were run over here, but there was a massive rejection, and I would describe the spill. You referred to it as the August 9th not-for-profit sale very much accurately, that the reaction to that was subsequently very, very firm. So that brought you back above this temporary level, key round number 1750. So you've got quite a hard floor 1680, and you're starting to lay down some semi-strong floors at the 1780. This blue line is another double bottom that's on a lower time frame in here. I'll spare you the additional technical detail on that because we want to get to where we are now and drill it down for what's short term on the way. So I'll keep drilling down and dropping you in. And so couple of structures that aren't overtly particularly optimistic short term. that say we kind of pivoting and battling with the 1800. Again, round numbers are significant. Derivatives, and many people will shake their head, and a lot of theories will come out when we talk about precious metals and derivatives, but they certainly are a key element, and they're all based around round numbers. It's called pegging. So this is fascinating technical concept as well. Now, if I were to just do a little bit of a draw off the splitter here again, you can see we had a bit of basing up. In fact, let's just do it with a normal line. We had an up leg into here. And then we got this kind of flat bottomed broadening structure. Unfortunately, that's not typically optimistic structure like that over there. So you're going up and you're getting what this is an ascending megaphone. So we use the splitter. That is an upward ascent. So we call the whole structure ascending, and you usually let go. And it dovetails with a key round number. You can almost watch it to the key that at the end of the 1800 line, that's when that went all spiller and thriller on us. That's a key technical level. And you were trying to hold above it on support, just running it, typical classical key levels of significance according to HVF method theory. And then you fell, then you got your electric bounce. Now, here we go again a little bit. There is some similarity in this. A rally, once again, you're running that key level. You're not being allowed to get too far away from it. And you've got an ascending megaphone again on a bullish pole. These, again, technically could set you up for falls. And even if we look on a shorter time frame, we're getting this broadening structure, flat bottoms, high along the top over there. It's not very well drawn by me, so I'll try a different color and maybe thin it out just so that we can get that point coming through. But we're leaning on that lower basing line a tad, a little bit much for my liking, leaning on it a little bit. So we're battling with the 1800, and you could just see one last relapse. I don't envisage a revisit to this level now. I think it's been well proven. And I think people have seen that movie before. So each successive visit, the market gets slightly smarter and they react less violently. And this was a real spill, as you've already recorded. It's unlikely to have gone to happen on that scale again. So we might just let go of this level again before setting up and moving towards this key level. That's the capping descending grind line that we said will be broken. And we call that squaring up, but we don't look ready yet. We don't look ready yet. I'm not here to tell people what they want to hear. On the macro, I think I'm very aligned with what everybody wants to hear, and there's good news to come. And as I say, we'll do a quick run past those energies to show that, you know, the commodities can sure do it. So that's the gold breakdown to quite a low time frame. It's disappointing. Incidentally, we had a small trade on non-farm day, and this is why we currently do what we call the shoot and scoot rules in our trading. We have live trading day on non-farm payrolls day, and we traded this little structure, and we had target over there. We had a little primer wind up, so we were getting long there. And we closed. And this is the value of targets. Until gold is in a significant confirmed bull, you're applying in our trading technique. So we're investors and traders. There's two different things. One is you're accumulating physical and you're holders of the metal, and you do it at timing wise when it's beneficial for you. And the other is trading, where you're just trying to build extra profit out of a set of circumstances. So the non-farm payroll we called was going to be bad. We said this is going to liven gold up. We put a risk on this small little fractal. So we actually have what we call an HVF setup with an even smaller one. That's that squeeze in there. It's a volatility squeeze. And we had a target up there. So you were actually looking at this trade, and we took this trade. All the attendees, including some people that aren't members of our community, you can buy in if you want to have a try, by the way, and we will be doing it again. You can decide if you like the cut of our jib or not. But this structure was great. But the key thing is you had to close. Because if you didn't and you held, you would have not only worn it back to your entry, but you would have worn it all the way through. So if you didn't have stops and targets, and you don't have what we refer to as the shoot and scoot adherence to process rules, now when do we hold for overperformance? Only when you're in the confirmed macro bull. And gold is still technically in a congesting pullback from previous highs. So we are still awaiting that moment. So that trade still, in terms of risk reward, is a 12.44, and it gave us the heads up on what we expected on non-farm. Now, those of you that follow the data number will know there was a massive miss on the last employment number. And that, of course, was weak for the dollar. Powell backpedaled a little bit after that in Jackson Hole, or was it just before? I can't quite get the chronology right, one of the two. And the tapering narrative got a little bit watered down, which for us, we never took very seriously in the first place, it has to be said. But anyway, the rest of the market's reaction to that. So that's just an example of how you can get a technical trade going and what we did. So that was
Francis,
a nice.
Why did you expect that out of the non-farm numbers and expect that reaction in gold?
Well, what we expected, so whenever we get a setup, the default assumption, especially if it's a good structured one as this one is that the gold is going to trade higher from the level, and we were buyers at the 18.15, and we expected to pick up $20. It's a small time frame trade. I can drop a time frame for you, but the structure was good. So coming into it, you were clearly in an uptrend. That's the orange line. And then you had your squeeze like that. And that's a continuation pattern. And of course, the data was the key. But it's amazing to me, and I call HVF method the forensic detective, how there seems to be people that have good information that set up the structure that were anticipating a bad number. And I don't doubt the footprints in the sand. I'm a tracker. I don't know where the animal is. Other people seem to know that shouldn't know, and they seem to know before any information is available. So in terms of Chinese walls and insider trading, let me remind you that the Swiss National Bank's wife was a Forex trader that traded the collapse in the Euro Swiss franc. That should tell you all about propriety. And two Federal Reserve heads have more recently have vowed not to undertake any further trading due to deemed appropriateness with regards to this. So it's a cartel, it's a club, like George Carlin said, and you ain't in it. But you can profit from the insider's knowledge. I call this the forensic detective. This is what we do. I've actually made money on mergers and acquisitions, even ones that got cancelled and ended up not happening, purely on account of having targets and set up much like this. So that's the value of being a technical trader if you have a process and you trust. But remember, with all trading activities, you can be wrong on the loss. But this over pointed to an upclimb in gold, which means relative devaluation in dollar, which meant the notion of a strong economy was likely to be challenged. And hence, that's why it pointed to a disappointing non-farm number. So I think that's the answer to the question you are asking. Mm-hmm. But so, let me know.
Are you at all taking any of the macro factors or the news stories from day to day? Do you try to take that into account, or are you just looking at the technicals as the footprints, as you call them?
Absolutely, very good question, and it's a mistake so many people make. Mm-hmm. When you choose the trade, you can't be a giraffe and a wolf. You trade technically. I trade technically if you trade technically. If you're a news trader, don't look at technicals, trade the news. Personally, my personal opinion and assessment, not wanting people to lose, is that by the time you hear the news, everyone else has already heard it, put their pants on and run around the planet 3 times. So don't bother. But, some people think they can have a good guess at what the news will be. And being once right is often positive enforcement for negative behavior. So I'd rather see what people do than what they say. And the closest iteration of what people do is following their footprints in the sand, which is the technical analysis and the movement of money. And that's where I am. I pivoted to silver while you were asking a good question. So trade technically, invest fundamentally. You can still invest, by the way, macro technically. Many people think there's this common false must repeated mantra that technical analysis is for timing. I'm just saying, well, then you're looking at too short a time frame chart. I look at monthly charts. You can look at annual charts. Things that have been around as long as gold and silver don't stop you from looking at it. And believe you me, the principles apply even better on the big time frames than they do on the smaller time frames. So technical analysis is very useful for investing. You may have just investors watching and saying, why am I hearing about a 20-minute trade that pumped $20 just on non-farm? Well, apply those same principles on the big time frame. And we'll show you that in the oil and the energies when we go what might be when gold gets uncapped in a minute. But a slightly positive point is that I don't think the pain is going to be forever. And on silver, many silver fans, I'm a massive silver fan. I believe everyone should accumulate physical silver. as well. I think gold leads, but silver presses home the advantage. So gold's kind of like the forwards in a rugby match, or maybe your in the NFL equivalent, it'll be your line of forwards. But the points, who decides how much you win by, is definitely your running backs. So you need gold to do its business and lead, but then you want your running backs to max it out. And that's determined by how many points you win the game, if the forwards decides if you win the game. So the falling wedge is what I'm going to highlight here. It was a bit of a grind line. We said silver was going to go down. This red line was a concern when we were here. And again, this is the broadening structures that I was warning you about. We kept having resistance. Silver has a history of resistance here at this $28 level. Here you had, this was your Reddit spike that couldn't hold for very long. Over there, just iceberging, small little tips of icebergs over this waterline at $28. Really significant level that we've drawn and we hold. It's always on my chart when we're looking at silver. And if I just go back out, because we started at the macro on silver, on gold, we should do similar. Where does that 28 line come from? Well, it comes from the key round number that kept being run when you were making this macro descending triangle. Monthlies may be a bit big. I'll go bi-weekly so the guys can catch it a bit better and a little bit clearer. But there you have it. Just run 28. Even when you hopped onto this ledge, you revisited it for support. So here's the levels I'm showing you. And what was previously key levels remain and stay key levels. Broken with momentum, a little bit past, exhaustion, support. Hammering support, just run, hammering support, hammering support, hammering support, hammering support. That was why this was such a huge failure and a signal for a bear market. Right there was your bear market signal for silver. I mean, we're not looking at the gold chart anymore. Obviously, gold would have probably signaled as well, but there were slight differences in times for when they peaked out. And silver might have been earlier or later. I can't quite recall, but we can check it out. But this, unfortunately, was a death knell for that measure. So you have done the better part of a 2013 7 to 8 year round trip cup getting back to that. This big draw. This is why I'm saying, you have progressed. It may feel like it's glacial relative to all your friends teasing you, but you have progressed and you've come back here. And now we are playing with this level. And we weren't just ready there, as I was showing on the smaller time frames. And you've had a little bit of a dip back. But I'll show you something that'll make you feel a bit more optimistic. This could again be, you'll be talking people, traditional technical analysts will talk about cups and handles, bit of a complex handle here, but let's drop back into the small time. I just wanted to highlight to you the real relevance of that 28 price level and how it's been the bedevilment of silver. But what hurts you to get over, once you're over it, is backstop of great scale in terms of your progress. So while it's a big obstacle to climb, it's very positive when you do get there. So back to the shorter time frames, and we'll have a little look at how it's playing out for you there, and jump in at any point you want. We did see this grind line. We call this a basing ascending grind line. It's a problem. You started to show that you're having some support level buying there and that it was moving up. But then we were seeing this sort of staircasing, but then we were seeing the structure of this upward grinding line, and you were touched once, twice, and you let go on the third time. And that was following a selling bear pole after a failure for the third time again. We'll treat this as one major event leaning up against the 28. Here's your second attempt, the Wall Street bets and the weak rally that came afterwards, again, in a bit of a bear flag there. So you're always going to go away and try one more time. And then you squeezed up here and you just couldn't hold, descending triangle down. This is that ascending megaphone. There's a slight ascent to it on a bear pole. That spells continuation. Down you go. You break that almost a rising wedge line structure because you've got the 28 as your top there. You have a revisit with a bit of a flag, and then you spill. So this was well on the cards technically. Last time I spoke to a precious metals guy, we were in and around here, and I said, no, I think we're going lower first. I'm sorry. And this has now happened. You've gone lower. And slightly not great news is that, again, you're broadening. It's not ready to go, and it is an ascent. But here's where it gets a little bit more positive for you. We talk about three impulses in a falling wedge. So this is very common, and this is all HVF method. So those that haven't come across this before, they can find out more at the Market Sniper about our trading methodology and how we do it. But you typically have one that runs to your splitter as your first defining wedge. It usually runs to your midpoint. You'll see that midpoint line is in there again. Then you usually get quite a bloated second impulse. I'll change color even for that. So you're going right the way up there, right the way, all the way down. There's a real spill. That's kind of your second impulse. Now we're awaiting a third up and over, and we're already in the up part, which is kind of slow and grindy in this broadening structure, which is setting up, creeping up, and maybe another little dip down. But it will not be as bad as this down, and it will be providing an excellent buy opportunity for this falling wedge event. So guys could be accumulating here. Don't forget, this has proven and not been broken as a great layer of support. So limit orders to buy in and around the 21,750 to the 22 zone will get rewarded, in my opinion, on another dip off in silver. Not what you want to hear, but potentially very good news if it happens, because it flushes out the last bears. Then we are breakers of this falling wedge. And a falling wedge is inherently, in most instances, a bullish structure. So back to my transgender pink favorite color, pop, 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 return move, and up you go. And then we have refreshed after an extended repeat attempts to go 28. I think this time we have a small pause and then we break. And that we will be up above the 28. And then you have a real concrete wall to your back. So that's when people start to feel better. But the trade and the investment opportunity is going to be here on any sell-off. In your 21.5, 21.75 is the number actually to 22.75 ounces. So I am saying to you, you can buy cheaper than where you are now. And that should be the beginning of an initial move back towards the key resistance level of 28, probably another pullback again, but this time we cross it with momentum. And that when you cross, you normally break a real challenging level with real momentum when you break it. So there's often immense follow through. You could see 30 and 32, 33 as part of that, and then a slight slump back. So it's exhausting. It's kind of like the horse that takes a big long run up to clear a hurdle. It doesn't stop straight after it. It's got a lot of inherent momentum in clearing one of these biggest hurdles that it's battled with. So there's roll on and follow through. So that should cheer some of the guys up. Other key points that I'd mention on the precious metal space, using the technical analysis that we do and the methodology that we do, HVF method, is the key ratio between gold and silver. So it's fascinating and been absolutely fascinating. I will remind people that we called literally the turning point up top here at 113. This was going to be downside. This was the best moment. And in fact, silver traded in the 11s in the COVID capitulation. And the entire event was a final blow off of a macro rising wedge. So wedges can have a pop out the top. And this was that structure. And I just once again remind people of that. You were running right through that and you had your blow off out the top before spilling. So the good news at the macro level is we've had an all-time blow off, ridiculous silver valuation to gold, which actually on this chart hit around 128, depending who your data provider is, it might be 125, 126. Don't let's have a fight over the number, but it's sub 120. But this has been such a capitulative reversal. Now, 70 is like the 28 in the silver, a bit of a key level. There's been lots of interactions on the 70 in terms of relative valuation, just above, just below. You dropped when you spilt, and that's where you had your first key bounce. Then you went through it, but now we had a little bit of a loss of that momentum and we popped up. So let's just have a look at that. And I'll take the eye off for a second just to reduce the intensity of all the draws that I've got on there and just clean the face. But this is a counter rally in what is a reversal bear trend for gold and silver, which is kind of the exact opposite of what we're in. We're in a bull market, gold and silver, but we've had a pullback period. You have to be patient. Remember, you've benefited from this entire reversal move down into here. And there was only one meaningful counter rally before it there. So this is slightly bigger and it's also flatter. You've had that. So it's not the end of the world. just been a little bit more patient, and you've got a really strong level of 70 at the moment, which has kind of captured most of the modern era. We've been in and around it, apart from a few major spills. So it's going to take some getting away from, in the same way as the $28 is going to take some getting away from. How does that sound? Do you have any questions on that? Because I've been rattling on for a bit.
No, Francis, you're doing a great job of, really explaining how all of this is playing out. And I don't really have much to add here, but this is again just based on the technicals that you're seeing this, right?
Yes. Mm-hmm. And actually, again, to prove the validity of what's unique technical analysis theory to us is broadening structures. Here's your bear pole, your first selling, and an ascending as continuation. An ascending broadening structure means continuation. Bang. Another ascending broadening megaphone structure spells continuation. Bang. There you go again. Now we've kind of slowing down, marginally lower lows, hanging above the 70, broken with momentum. Bang. But then we were in a bit of a rally channel. And I thought, okay, at some point we're going to come and spill and let go of this. We actually popped out of that channel, which was slightly bearish, but we're battling to get away now. So I'll just drop a time frame and take you into that view so that you can see how it's the gold-silver ratios.
Before we, I was going to ask Francis, the splitter on the wedge is something that I haven't seen before. So explain to us a little bit more about why that the splitter line is useful.
Absolutely. It's unique to us. It's part of HVF method. I'm seeing a lot of people on Twitter now starting to imitate us. I suppose imitation is flattery. We don't only split our wedges, falling and rising, we split our flag funnels. And what you find is you often get a segment of a move. You don't always get the full move. Also, directionally, when you're trying to assess if a megaphone is an ascending or a descending, you might have both lines ascending or one slightly descending and one ascending. You need to determine the overall gradient of the structure. So we call it actually represents the aggregated gradient. So if you look at this falling wedge, the aggregated gradient from the midpoint being perfectly split through shows that this was a downside falling wedge. In this instance, on wedges, both lines are down, so it shouldn't be too shocking. But in megaphones, it's particularly useful. And you can see how you get these half moves and clings to the halfway line. I'm not in the best example, but already here, you can see to the full end, to the halfway mark. Then you hang the halfway mark, then you go to the bottom. Then you go right across because you're now breaking out the wedge. But you can see here, and you can see there into the midpoint. So it plays out a lot. And similarly with this channel, we've just got a fractal of upside. This told me gold was going to be outperforming silver and possibly it would be going badly for precious metals. Remember the gold-silver ratio. We don't want to see bullish price behavior. You've got an HVF and you've got it close to the 70 key level, but also at the splitter level of this flag. You can see the softer line that's drawn here. So there was a natural sniper's sight of splitter flag funnel, fractalization leaning up against it, and the key level of significance, which was horizontal, which is pointing out, gold's going to be outperforming, your silver's not going to be doing great, and precious metals might actually be a tad weak during this period. So you can see that this bullishness has not been particularly good, but it is tiring. It doesn't feel exceptionally bullish, and you're having a little bit of a drift off now. Again, we had it here. We show you another fractal where we said overperformance gold to silver on this very small time frame. So you can see we really engaged with metals, and we do look at this on an ongoing basis. And most of what we've drawn, this was highlighted in my community before it broke. Gold's going to outperform. That you could have gone short silver, long gold on this, and that keeps you neutral to whether the overall market is going up or down. And boom, up it goes. But then after you get your impulsive break, you started to churn, you have a blow off, you come back, and now you're sitting on our key level of significance, our target. And in actual fact, you're starting to put in a broadening structure over here, again, along these key levels. So this is a real technical analysis 101 with HVF method that your guys are getting, and you're getting a split back. So this is overall bullish because we want to see this. It's battling with this level. We want to see it if it's going to let this go and come back down. And that's going to point A, to gold getting stronger, B, silver getting stronger still on top of gold, which overall will be more bullish. So we'll be watching that. And that could be a beginning of the reassertion for the downside. And again, we want to see that 70 blue line that is some way down now out of shot fail. and then fail with momentum, which will be very, very positive. So a couple of thoughts on the gold silver ratio also thrown in. What about the future? Let me do, before I go to the future and what the energies have done, let's just also go on one that I actually think is interesting for some of the guys that are followers of the overall platinum stroke palladium group of metals. So palladium was an outperformer in the early part of this bull run. There's guys will just love seeing this chart, and this will give them some comfort potentially for what could come. But we were down at $189 in 2009, and you traded up. This is a log scale chart to 3,040. So the notion that something of $200 can't get to 3,000 can be put to bed. You've done, what's that? Is that a 150x? It's substantial. So that's 150x in a precious metal. Okay, it's not overnight. We're talking about the better part of a decade, but it's still phenomenal. And we've yet to have the whole fiat reset. It is looking weak. This is a bit convex and a bit of a pee off the roof. So we've calmed down a little bit on palladium enthusiasm. It's got a bit ahead of itself. But interestingly, it was kind of counter trading platinum, because palladium was being utilized more in the hybrid vehicles. And as diesel vehicles were being cut back, platinum was getting less industrial demand at the expense of the palladium. So palladium was kind of getting the benefit of the double run that platinum should have got. So I'm ending up taking you to the platinum chart, which I feel is in a falling wedge. And I'll talk again about 3 impulses in a falling wedge. We'll drill down. But before I do that, I want to show you the macro falling wedge. So as I say, you want more than just timing out of your precious metals. Look at bigger charts. I'll make that a regular scale just for now, just to capture this correctly. Platinum is the great underperformer in the precious metals complex. It is exceedingly rare. It's like, if you can get 2 or 3 Olympic pools of gold, I can tell you platinum is an absolute fraction of that. An absolute fraction. It is exceedingly rare. And the places that bring it is South Africa and Russia, bring about, I think it's still close to the 80s of all platinum. Yes, they might find a bit in Canada, might find a bit in the US, et cetera, et cetera. But this is an exceedingly rare. You get fragments of it. So this is already in a macro falling wedge break. So you are hunting in the right places, guys. The big resets and the big macro charts are telling you there's a major bump to come for this. And in fact, it partially started, and you've got a kind of broken third, and you've waited so long, some of you, but a sort of flat and broken. You always have the bloated second impulse. You've got a pretty flat third impulse here, and then you've moved up and broken this falling wedge. So the break of the macro has already occurred. Now, typically what happens in falling wedges is that you get what's known as the return move. And you've actually had a substantial return move, although you had a brilliant break. Platinum was starting to make a bit of headlines at one point, traded 1,332 from a break around here where you still could have been buying it in the 800s. Well, you're not far away from buying it. And normally you only get one serious, meaningful return move out of a trade. So we're going from the monthly, and I'm going to take you into this return move now. We go straight down into the weekly for you. And I might even drop that into a 2 or 3 day, as we need a little bit. Let's go 2 days or even the 1 day. 1 day. Here we go. We can squeeze it in on the 1 day. So here we were. Now, when the non-farm payroll trade came in, platinum also had a fake break. It started to go and was turned away and is finished now its third impulse. It's finished now its third impulse. This is kind of a complexity, the spike to the splitter. This is all one massive impulse there when it was rolling over. And this is still on a daily chart. This is a lengthy play out. Then you got your second, you went up there, you were rejected again, you've come back down again, and now we're into the third game, the third and final innings. And we've had a blow off, almost a spill out the bottom. I need to, again, I've got to probably jump back to log scale. That's why this line is slightly shifted in my draw. There you go. But this is, where the silver was that I was telling you, that's going to be your buy zone, 21.75 to 22.75. You're going to be able to get it cheaper, and it's probably then going to move. You're then now on platinum. Right now, you literally could hit the market bid in my take. In other words, you're in something that's already broken out of a huge falling wedge, that's in a return move. And that return move is another 3 impulse falling wedge that is at its lowest point, in my opinion, technically. How do I be wrong? You can always be wrong. You turn into a very rare type 3 spiller, especially considering you're already in a macro upside break that implies monthly long-term bullishness. So I acquired some platinum. You're buying it below $1,000. It's $939 at the moment as we speak. And the next journey is an upside break for us on platinum. So very, very bullish platinum call right now. A wait for a little bit more downside, possibly on silver. But if platinum starts moving, it'll be the early canary in the mine this time. It is crushed. If I sometimes do the platinum divided by palladium, I do it on a different, I'm not sure if we've got time for that. I've got the time, but I don't know how much detail you guys like to do. But the difference in valuation in platinum versus palladium has been so brutal and so over the top that there's invariably a catch up to be had by platinum. Let me see if I've got that chart quick to hand. This is platinum divided by gold, which it's also underperformed. Let's see, platinum, what have we got? That's platinum US dollar, where it's very similar. Just put that chart up for you. I think you'll find it fascinating. I might have to just type it in, platinum there, and let's just divide him by, instead of gold, I'm just going to show him his stable mate of palladium. Palladium US dollar, we'll go, is there an O-ender? There's an O-ender. And we hit the entry there. Now, if we go up to the bigger time frames and I break it down for you and go multi-decade and just get out of the log scale for a second, that's platinum divided by the palladium price. And let me tell you, you're on a monthly chart, guys. You are on a monthly chart. I grew up as a South African, knowing miners, and platinum was always more valuable than gold, always, and by quite some premium. It varied, it vacillated. This is a recent phenomenon, platinum being so crushed. It's a recent phenomenon, and I think a lot of it's been driven by biases in industrial demand. It is exceedingly unique. In short, at this high point in 09, which is interesting, we're mentioning 09 again, bottom of the great financial crisis at many, many levels. The palladium, you needed 5.5, let's just check the number, the high, 5.5 palladium ounces to get just one single platinum ounce. Today, you need less than half a palladium ounce. So you've gone from 5.5 to just needing the 0.5 to get one platinum ounce. And that's in 10 years. This is a crushed falling wedge of great scale that has been falling immensely, and it's dribbled out a little bit Pippi style out the falling wedge there. But I think there's going to be a moment of truth where this then turns out and the uniqueness of platinum and its usability will come in. Obviously, industrial demand, but I think this is excessive. Whenever a market moves to an extreme in one direction, you normally get corrective behavior, and investors could indeed benefit from that. It's one of the most beautiful metals, I think, personally, but that's a taste. And it's tough to get it out, and it requires energy to get it out. And what's happening? Well, let's talk energy markets, because this could also bring, I mean, were you to return to 5.5?
I like the point that you made there, Francis, about this market extreme and the opportunity that it presents for those that are recognizing it.
100%. It's flattened. It's been absolutely flattened. Were you just to go to 3 as a falling wedge break, with the current price of palladium, if you're just to rebalance, this is no reset, no fiat, dollar stays the same, no more printing, no financial crisis elements, which we all should really assume as baked in and guaranteed, just a question of when, but let's just park that. If you just had a rebalancing in the relative valuation of platinum and palladium, if it went to 3, you're at 2,000. Palladium's not doing particularly well, but it's at $2,000. That would put platinum at $6,000. Make it 2.
So it's 6-time move from here.
Yeah, and that's without any reset financials, that's assuming the dollar is the same buying power dollar that it is right now in markets right now. So, and that palladium is after palladium that's actually fallen from being as high as, near the 3,000s. What's its highest watermark? I'll just take the eye off lots of the scribbles on there. You're talking about it at $3,000. So imagine you were 3 times $3,000. Imagine you got to 5.5 times $3,000. Imagine you readjust, and as far as you break to the downside, you break to the upside, and platinum goes to 10 or 15 times. Now that's maybe a bit fantastical. Then people will say there's not the industrial demand. You'll watch how things change, supply and demand dynamics. Mm-hmm. So with palladium just standing still, if you went to 10, that would be a 30,000 palladium ounce. Who knows? So you can, there is blue sky thinking that can be done in and around that. I mentioned the energies to give guys hope. Well, we started off mentioning how the UK is having problems, supply chain. I mean, mining and supply chain can get disruptive too. You don't just open up a mine. It's not a 2-day event. The surveys, the digging, the intensity of it all, it's huge, huge, huge. Natural gas, let's take that one in actual fact. I prefer this chart. This is what natural gas has been doing lately. That waste product that used to get burnt off, we traded an upside HVF over here in it. I wish we'd held on longer. We took our targets off and they were driving fundamentals in this. But this is literally a very, very 3.8 to 5.56 in 1, 2, 3, 4 weeks. That's less than a month. That's phenomenal changes in what's supposed to be a dull, boring commodity that was waste for the US market. Then you turn to uranium. And there's been a lot of fans.
Francis, before we move off of natural gas here, how do you analyze that chart to kind of try and figure out where that's headed now? We get that big, not necessarily a blow off, but we've had that big rise. So how do you try and analyze, or what type of chart pattern do you put on there to try and figure out where that's headed?
It's too late for this market. Technically, it's in a runaway market. To chase that, the question is, if you're trading with leverage, where's your stop? Well, it would have to be down there. And what's your reward? You have to expect that amount to the upside. That's an assumption that there's no geometry based for. So as an investor, you could accumulate on dips. The original, the one you missed, and this is the key thing about technical analysis. A lot of the times you shouldn't be doing anything. That's just the one that got away, and there's plenty of markets. The truth of the matter is you don't have to catch them all. You only have to catch 1 or 2 good ones. And there's a lot of this happening all the time. Mm-hmm. And there was another setup we drew over there, a small one that bumped and ran, and then it had a pullback. So we were involved twice with this. But this bigger target was made, and you actually got a confluence of targets. What's nice about markets is they talk to you. This confirmed the other one that's saying, hey, you've got a great target coming on here. You might have a pullback after that. That's your first meaningful target. But you also learn this is a first in a new trend. This was your low for natural gas. So this is a first in a new trend. You should be applying overperformance rules. This is all HVF method rules. And you asked the question. I'm not selling this. Mm-hmm. I'm just saying you're seeing how overperformance works. Because what actually should happen is you do partial close there and you do what's called overperformance management. And there's an entire methodology that we utilize for that. And it involves letting a blow off run and only pulling it back when its gradient reduces and it comes back down. So you harvest a lot of the blow off. And in this case, it's insane. Without giving too much away and getting too detailed, you would essentially from your break off have done something like that and run along the lows. And you would have put your splitter in there and you said, that's still a blow-off market. We stay in it until it runs back and breaks this line, wherever that line is. You can't set a price to that. You have to observe it. So it requires slightly more active management. And as long as it's going up quicker than the upper side of this gradient, you stay in it. You stay in it and it can become a Hail Mary home run on many times over. But we detail that far more detail if the guys want to pop over to themarketsniper.com and learn how we trade energies, markets, and cryptos, which we're doing all of the above. Did I answer your question there? Is there anything else?
Yeah, absolutely. Yeah. So
Yeah, so
you were going to move on to uranium here. We've seen a lot of really important developments in that market. So how are you seeing, from your perspective, from this technical perspective, what's going on there?
Yeah, well, it's coming alive, isn't it? It had a very flat bottomed, almost triangle, maybe not quite a wedge. You can see it maybe there, it's slightly wedge, or it could be a triangle. But it's been a squeeze of the volatility, and that's always good because that sets up impulsive action. You can see a flag structure in there, and your first blow off from a very low level. I can get a value for you there. This is on the monthly. Again, we always start on the big. It's 0.13 units there, now trading 3.41. So we can drop down and see, but this is now broken out of this crushing of the volatility. So it is in a very definite recovery position. Mm-hmm. And if I were to look at it now, it's got a little bit volatile. It's a tad rough. It was squeezing up higher, and this pointed to a little bit of a pullback. So round about here, you get the broadening structures that I warn you of, that highlights. Now, we call it a slide when it's downwards, and I gave you an example in gold, but you get what we call a trumpet here. So it's not a megaphone. Megaphones are smaller and they're on poles. This is the entire move is in an ever more volatile. So that warns you you're getting too choppy. Initially, you swing there and you swing there. Then you're swinging higher. Then you're swinging a lot higher. You're swinging a lot more. That shows an unsteadiness to the up ascent. That means uncertainty and liability for the basing ascending grind line to be broken, which is exactly what occurred. And then you have your pullback. Then it calms back down again. You can see the volatility dropping here. You can see a basing descending grind line showing that there were tactical buyers coming in along here, and you get very close to a double bottom. You get a double bottom turning. You have your W bottom in there, and that says, okay, we're done chilling out after getting a little frantic in the trumpet. And now we go again. And then you project your double bottom target, and you can leave a bit on for overperformance. And that's where you're getting. Would I enter this market now? No. Mm-hmm. Because now you're at previous levels where you're ejected once, twice, 3 times a lady. You maybe even say there's fourth, maybe it's a transgender lady. I don't know, not quite the bullet. And then you get up to there. And you're at a previously proven point that is a little bit sticky. That is not an entry point for new uranium investors. It could even be a logical target point for existing holders. So if I put that line on there, you can see that and how it's playing out. So right now, I'd calm a little bit down. I wouldn't be entering. Mm-hmm. And I might even be, if I was in dispersing. I have calls on an equity. In fact, this is the equity. I think it's Uranium Energy Corp. Yep. I should be showing you the actual market. My bad there. I was looking at the equity, not the actual market. It's the one below. These elderly eyes. That's the ETF. That's the uranium ETF. That's more closely to the commodity. So I apologize for the equity analysis. I did the equity analysis thinking I was looking at the commodity. This is the commodity, or closely tracks the commodity as an ETF. Now, in this instance, this has been a blow-off as well. You can't enter a blow-off like that. Mm-hmm. And again, I'll just warn, it probably means you're going to get some degree of correcting. Mm-hmm. You can see it there. You're starting to get more frantic. The swings are getting wilder after a bullish up move. So big broadening structure there. So that's a good take profit point. That doesn't mean I'm calling bear on the market. Mm-hmm. It just means the scope for downside correction and risk is far higher and larger than the assumption of any further blow-off gains. You had very high volatility here, and it's quite likely that next move would be something like that. It could even come all the way down to this lower level here. And then it'll calm, possibly break and wind up again. It can square up. It can do something a little bit less hectic. So I don't want to shake everybody out of their good trade, but you could just calm, square up, and then you can go again. But this volatility needs to reduce. So if I was drawing volatility measures, if we put the volatility indicators on that, you should be finding that the historical volatility is getting a bit punchy now.
Francis, I was going to ask, if there's any other indicators you look at, like the MACD, oversold, undersold levels, or even volume trades that are associated with moves like that.
Volume is very useful. Volume by price, the volume histogram. Yes, this is on an ETF. So bear in mind, we're assessing that particular market. So these are indicators I have. You see this blow off height of volume very close to highly extended highs. I'd be tempted to sell into that. I'd be locking in if I was in uranium personally, but that might be time frame. If you're trading for uranium to 150, be my guest and hold on, but be prepared to watch it go back under 20 maybe before it does that. So volume, very useful. Volume by price is another metrics that also highlights where a lot of the participation has come. So that's, from your low, you could go from the low, pull it through for this period and see how much volatility. You can see this big handle here, and we're quite thin up top here. So yeah, small temptation. As again, I'd still be probably taking profits on there. I don't use moving average type indicators. I go into detail as to why. Lagging indicators that are based on price that has been financially manipulated is not good technical analysis for me. There's quite a bit of dogma in technical analysis. Some people will be upset to hear me say that. They use it. They think it works for them. I go into more detail as to why we don't do that. In fact, it goes a lot for all mathematically based indicators. People are just looking for a smooth version of price. A simplified version of price. You should revel the patterns, the detail comes in the price. Don't look for an easier job, looking for some smoothed out, lagged, mathematically manipulated line. So that's the short answer on why I don't use a lot of the others. Volume is separate data, and it is distinctly useful. And you can see immediately from that there's a lot of participation in the market, and there was a real buying surge with huge gaps. By the way, something to bear in mind, this isn't the actual market. Again, I stress this is the uranium ETF, but there's real gaps in there, and you can get killed if you're on the wrong side of gaps, especially those that are thinking of leverage trading. I don't know if you can leverage trade this ETF. Maybe you can just invest on it only, but be careful of that in terms of liquidity. Be afraid of markets that gap open. It's great when you're on the right side. It's deathly for your account and you're caught on the wrong side. And then you've always got to play defense. You've always got to think, what if I was on the wrong side of that? So it could hurt bad. So a little bit of possibilities. I mean, it's just a fun number, uranium in not so long ago at the bottom of the pandemic was 18th March. Lowest value was 695, and you're at 2781 now. So that's a decent number for a bit of a turn. About a 5x, which is far from, and I do think this energy is far from over. As I say, macro, I'm a bull. I just wouldn't get involved here. I think you'll have better opportunities. But if you ask me where it is in 5 years' time, it's higher. But if you ask me where it is in the next 5 days, 2 weeks, I would not be chasing in there. Just because your risk, your last known risk stop would have to be right down there. So it's not a trade for me.
Yeah, like you say, there's going to be some profit taking, and with a move that was that quick with gaps that big, there's some significant risk that comes along with that, right?
Yeah, there's some forced buyers there that could turn into forced sellers later. So, yeah, this is not for. Don't matter what the price, just get me in, and fill me for my full size. So that's real market chasing going on there. And that kind of pandemonium can work in both ways. So I mean, that's a little bit of, I suppose, how things can spin. I mean, for a bit of fun, we can take in first Majestic. A lot of guys are in it. On the silver side, as I mentioned, I'm a silver bull, and we'll continue with the theme of wedges, because it's a very wedgy kind of market at the moment in this current realm, and it's silver very much the same. And I find myself, and this kind of gives you validation for your hypothesis. We still got the big super spike, but this is all still really largely two here has got to be at least one impulse. Then we've got the second being a bit more bloated and extended, over here, all the way down. We haven't finished with this third for me. You kind of need to get around there, and maybe you visit the midpoint or even all the way down. There's something more to happen here. We haven't yet got the third in the bag. So And you can again see these broadening structures leading to leak outs to the downside. So an ascending megaphone on a bearish pole, and what do? You bleed out to the downside. You haven't fallen too much further again, so there is reasonable support, but we got to get across to here and finish that third impulse, and there is scope for it to possibly dip a little bit before then, and you could get down here. Difficult to guess, but at some point that's coming. And in of itself, First Majestic had a bit of an interesting level at about 1725 and was being resisted here. It failed to hold above for any extended period, this funnel draw that I've done, which is around the $18.60, $18 level. So if you're in First Mag, we want to escape this falling wedge, get back up here, take back the 1725. We'll probably have a pause here and pull back, and then we can go. These were the highs. By the way, just to show you how HVFF method works, I'm actually going a shorter time frame, and I'll show you a little trick. You'll get the intraday markets on the shorter time frame. You'll see this background changed a little bit. This is pre-market. Let me just get rid of the scribbles there. Maybe I'll just make it 8 hours, go a bit up, 12 hours. You can see that we actually drew an upside HVF here that had a target there. And that was also our main second interim where we were going to have a rest. That level would be made, then you'd have a pullback, and then you'd be in pause for a while. And that occurred, and that got made, and it was made in the after hours market. So we literally sold a wick high without trying, 24.56. So that funnel was well justified. It's a smaller time frame. I'd have to drop it really small to show you that. But that little structure was our last successful big trade, and it actually was a precursor to the Wall Street bets pump. So that showed that there was early accumulation coming out of this rising wedge that was an upside break. And then you got that bump. So this whole structure, if I go back out to the bigger time frame, why are we talking about this detail? Where's that second interim? It actually ran that second interim. But when you go to the daily chart, it hides that's why you can't see that wick through it anymore. That's why it's a drop to the 12 hours. On a daily, they don't show you the pre-market and the aftermarket markets. Yeah, but that actually spiked through that second interim and then paused exactly like it should, which goes with the HVF method theory that we teach. So you are actually in to draw the big picture. And this is on First Majestic. We're now talking the equity. Let's go again with our pink. I'll go fat coaty so everyone can see it nice and clearly. We are in our opinion, on a breakout here that has a $34 target. And I think we'll overperform to that. And you broke, you came back. You've made that second interim and you pull back quite a long way. But if we break out of this falling wedge, we can get going again. We have great expectations for it. But it is going to rely on silver, and they are echoing the same thing. Not quite yet, but for the patient, there's some optimism.
And you talk about the opportunity cost for having your capital deployed in a particular trade. So if you bought earlier and you've been trying to hang on, hoping that it's going to go higher, if you are looking ahead and trying to analyze that structure, maybe it's better to try and put some of that capital to use elsewhere and revisit this trade once you see it starting to break out of that structure.
You can be damned by that because you can get out just in the wrong time. Mm-hmm. To be clear, we also, as part of our methodology, which is very holistic and very broad, we have a time period by which a thing should have performed or it should be closed. So we measure opportunity cost. We recognize there's a carrying cost also, especially for those that are maybe doing a leverage trade overnight. Each time you're holding it and it's not going anywhere. So there's the opportunity cost, there's the carry cost, there's quite a lot to do. So we through the geometry of the pattern, actually get a time stop. And I can tell you that this is just broken. They normally performance well before. We sometimes get 10% of the time utilized. When you get real rips, can be half, and that's average to almost slow. Mm-hmm. If this has plenty of time, the point that we would treat this as a timeout is 2029, because this is such a long, don't forget we're on a monthly chart. So every candle represents a month. This entire pattern's gestation, this peak of First Majestic last time at its highest high on record, 2682, occurred in 2011. Mm-hmm. right the way through to this break that occurred in 20. So you're talking about 9 years of setup. That gives a long period projected into the future. But typically when you do get the breakout and it is single-minded and it's going, you rip. So just because I've said 2029 doesn't mean I'm calling it that it will take that long. It rarely takes that long. But I would say it's had its chance at that point at the absolute latest. Absolutely. You could risk getting out at the third impulse of a falling wedge, only to see it bump in the next couple of months quite significantly, and then it could pause, pull back a little bit, and then rip. That's the problem with breakouts. You don't know its flight path, and things could get very disorderly to the upside very quickly, and you gave up on it after sitting through the desert. You walk the desert and you slit your own throat just before the oasis over the next sand dune. And that's kind of a tragedy. But yes, best thing is to have resources everywhere. I'm languishing on my silver trades. It's the one part of my portfolio that went down. I had a lot of great options that were deeply in the money. I closed them and rolled them up top here because I take, through the longest duration on Schwab. They're giving me till 2023 now. But it's the beginning of 2023. I closed and rolled a lot of profit in there because I've been buying the options down here. And I'd made great gains up to there, but I wanted to keep it at maximum time duration, and you start to have decay on your options. And since buying up there, they've done nothing. The new ones have done nothing but go down and spend time. So they've lost significant value. Yes, it's against the fact that I've already locked in a lot of upside, but the current stack is looking red. But that's a journey of confidence, fundamentals, and I have technicals in my favor. So it's just a case of sit out that red, baby. I don't really want to reallocate capital. Have more capital, build a business, make more money. Hold on to these because the day you get out is the day it dies and pumps, and then you're in regret. You can't play whack-a-mole. There comes a point where you can't play whack-a-mole. These are big time frame structures. You've got to decide if you're in this for the long run or not. If you're chasing everything that's flying, you resort to becoming a momentum chaser. You forego all process. You chase pumps. It means you'll be running into natural gas and uranium now at these giddy highs. You'll be wearing 50%, 60% pullbacks, and your silver will start running. You've got to have enough beans that you can play a number of games and recognize that one's going to be out of cycle. If you chase the pumps, you become the dog that chases moving cars, and then you're all vexed and don't know what to do with yourself when the car stops. And the FOMO chasing is absolute trip to trading hell and investing hell. Because you'll always be in the wrong place. You'll feel like the unluckiest man. But the problem is you're always electing to be late to chase something that's already gone, thinking that it's now a certainty because it's moving, only to buy the top and to wear the elevator to the downside and never be part of the escalator up. So it's much better. It's a bit like changing wives every time you saw a woman that looks more beautiful. It'd be an occupational hazard. You just think of the alimony and the divorce settlements alone, and that should keep you out of a notion like that. And the notion that all you do is you change one set of problems for a different set of problems. So best to just be happy with what you got and work with what you got and make the best of your decisions. And if there's real fundamental and real technicals, you bought quality, you married quality, stay with the quality and all the original reasons. They're probably still there, but they will have their high and low moments as all things. And be more stoic. As we were talking about the stoicism, about these are times for stoics. Patience and living each day and making each day, and discipline and adherence to process instead of the giving into an emotional frustration.
That's absolutely something that is, really paramount to trading, is trying to take the emotion out of it, analyzing the charts without emotion so that you can make, proper decisions instead of, exiting and entering trades just willy-nilly. Francis, one last thing I'd like to touch on with you there. You said that you should focus on maybe building a business, building other streams of income. So how must we value wealth building as a priority in our lives? And how do you frame that skill in your mind?
Yeah, very highly. I'm fortunate to have a work from home cash generative business that I've spent, but it's the passion of love. I would almost say I'd be doing what I would be doing whether I was being paid or not. Mm-hmm. That is great help. So find what you love and what you're good at. You might not be good at it straight away, but if you love it, you'll become good at it. And if you're good at it, learn to love it. But one way or another, stay there, because there's a talent there. And I was exceedingly narrow. I mean, I was fired out of a succession of jobs. I was perpetually bored and perpetually chancy and reckless and things that didn't inspire me. I couldn't hide. I couldn't hide my contempt for them or my lack of interest. And as a result, I have to be engaged in a place that is highly energizing, and it brings you to your highest energy and allows you to be your best self. So the identification of that process so that you can be in your best self, in your highest energy. I mean, this doesn't work for me talking to you about these things. There's a life coach in me. There's a real teacher who wants to see people expand in me. There's a real passion for markets. There's an absolute love for technical analysis. I am sitting in my chair. But God, did it take me a while to find that chair, but it doesn't matter. Because once you land, you're in the seat of power. You are your superhero best version of yourself. And people should focus on finding that self. There's some younger guys watching this, know thyself is the great journey. And trading for me, an investment, is actually an accelerated journey to learning thyself. So it's amazing how life coaching or self-coaching and growing and motivation, how trading is the perfect amplifier for finding out your weaknesses. And you will rinse and repeat errors repeatedly until eventually you say, I'm going to be different. You need that deep-seated psychological change. And trading, again, is an absolute weapon for holding up the mirror and the cold, hard truth. People say, are you blue pill or red pill? I don't take any pharmaceutical of any variety, but I take my truth like my coffee, black, dressed in black and real bitter. And I can certainly say, be focused on the real hard, cold brass tacks of who you are. Dispel fantasies. Avoid notions of things that you might be a pop star or whatever. If you've never practiced singing voice, you've never picked up a music instrument, if you know what I mean. Where do you naturally gravitate? I'd recommend great American Dr. DeMartini on finding your true calling. People should invest absolutely in themselves in the journey of knowing themselves and the true signs. And he has a free quiz on his website. Go and do that. Build a business talking about that which you most learn. I implement the thesis of teach what you most seek to learn, because my students keep me honest. I can never tolerate being hypocrite, and I keep advancing in an area where I'm performing actively every day in front of them. And if I in any way have not developed suitable, accurate, well rationalized theory to deal with that, then I have work to do to fix that. And so I'm super lucky in that all my passions are now combined in one great place. And I'm truly grateful for that. Keep a gratitude diary to remind yourself of things you should be grateful for in these times, as we've already discussed. And remember, start every day with a win. There's another, it was an American admiral that said, make your bed. Treat it as a small victory. Don't leave it to the servant. Just say, that's it, and you're ready. So each day you're doing something small in the plan. These are mental triggers. So you've got to win the conquest of your own mind and your own power of your subconscious mind. The minute you start controlling your consciousness as gatekeeper, and you do not allow people to program garbage into your subconscious mind, and you are the architect and master of your subconscious mind. Great American author as well, Dr. Joseph Murphy, The Power of the Subconscious Mind. Go read that damn book. Loved it. I read it over and over. Humbly written, but smart as all hell. Real smart ass. Probably the most life-forming book for me. So I've mentioned DeMartini, I've mentioned Dr. Murphy, and of course there was start with the end of the mind. How did I develop HVF method, by the way? I wanted to be in every pump. That's what I realized before it pumped. Mm-hmm. So who said? Stephen Covey said, start with the end in mind and work your way back. So I said, I want to be in this trade before it does that. What happens before that? Mm-hmm. What's the
That's
sign?
A great perspective.
And I went and rationalized it. These people have given you the clues to your life to go build the idealized life. Read good, intelligent books. Do not sit and watch the Kardashians and be brain programmed with passive consumerist garbage, drivel fest of drama and utter rot. Decide to not perpetuate utter contemptuous garbage that has been thrown around. Decide on quality. Decide on what you feed your brain is quality. You feed your body shit, you get fat. You feed your mind garbage, you get dumb, slow, and incoherent and consumerist. You've got to decide, are you an outside utter consumer, or are you also going to produce something? Are you going to leave something of value? Do you want to help and make a positive difference to people's lives on a small scale, not like all these people I've mentioned? I have people thanking me for HVF Method. I have them thanking me for the trading. I have them thanking me for the community and telling me the right things. Of course, there's an odd stone thrower every time in there in the mix, but you're on the right path when honest, grateful people tell you they're truly grateful. People that have got free views, etc. So get to a point where there's people thanking you, which means you have to commit to learn something really well where you can truly add value and go and add that value, and the thanks will come. And monetization sometimes follows later. Just be valuable for free. And then you can start finding how you monetize it later and manage your time. And that's the best I can do, and also live a little, get out, walk. It's my best inspirations is obviously very, very in markets and everything, but some of my best inspirations are when I ride my e-bike for fitness. And sometimes I record Reset Sniper YouTubes where I talk about the state of the world. Other times I just think, and then it allows things to come to you. Buy yourself time, some me time, do something you enjoy, and then read. Also reading books. I have a book list for traders that I tweet out so people can follow that. So there's lots of stuff you can do. And I certainly think the stoicism that I've referred to a few times, a few people have made it. Tim Ferriss pushed a lot. You mentioned him. He's done some good work there. Support him. Another great American citizen trying to do things that add value. He monetizes everywhere, and I don't mind him earning. Good for him. If he puts something and I buy it and it's something that's interesting, I'm going to sleep better. I'm going to eat better. I've read his books. It's good, go and do it, support him and let him get his affiliate commission for it because he's changed your life. There's a mentality of flow. I have people that have scarcity that sit watching my program. I do some free view YouTubes and they think they're trying to reverse engineer it and they're going to save the cost of the course. In me, they've failed already on mindset. Yes, they'll get plenty of free value and they'll get plenty of free stuff and they might even progress. But the concept of scarcity is their problem. Go for the full experience. Go for the full experience. Get what you really need to learn. People aren't going to give you everything for free. They need to be respected too. Money is energy. Allow it to flow. Allow it to flow into your life and allow it to flow out of your life where there's people deserving of that respect. And that's kind of the philosophies of the market sniper, the reset sniper, and the crypto sniper, and Francis Hunt right there encompassed. I don't know much more I can say.
Well, that was a great way to wrap up how you see the world, Francis. Of course, I really want to thank you for adding the value to our show and to our listeners here. For any of those that want to see more from you, you're of course available at themarketsniper.com, YouTube and Twitter through the same channels, right?
That's right. www.themarket.com is the website. You can book a call and have a chat with anyone, traders and investors like you. We don't, our own guys facilitate onboarding and go through the program costs. They are professional, but they're people that started initially. We recruit from our community, because they understand what we're doing and they loved it. And at the same time, the YouTube channel is pretty active, doing a lot in crypto at the moment because obviously it's an expanding market, which is getting huge ratios. But the Market Sniper channel will cover all the traditional markets. I've actually overdue doing a platinum bull call. You're hearing it first with you. So that's a bit of an exclusive and a premiere, Tom. So the platinum call is public now. I think it's bargain basement cheap personally. But I think all PMs are, but I think it's the extreme case. And so you'll follow there. You'll see plenty. You'll also see occasional equities and things like that, the YouTube. And see you at the website. But thank you very much for having me on and good luck to all your viewers.
Thank you, Francis. Really appreciate your time today. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.